Lease versus buy decision. The decision to lease or buy an asset is a significant financial choice for businesses, impacting cash flow, balance sheet structure, and long-term financial strategy. When a company buys an asset, it pays the full purchase price upfront, with ownership and control over the asset, subject to depreciation and potential capital gains. Buying assets can lead to lower long-term costs since after the asset is paid off, the business continues to benefit from its use without ongoing payments. However, the initial capital outlay for purchasing can be substantial, requiring financing options such as loans or equity. In contrast, leasing an asset allows for lower initial cash outlays, providing flexibility in financing without tying up significant amounts of capital. The leasing agreement often includes periodic rental payments, which may be tax-deductible, reducing the overall cost of leasing. Leasing also provides the benefit of using new or specialized equipment without worrying about maintenance or residual value. While leasing avoids ownership, it can be more expensive in the long term due to continuous payments. Financial managers must consider the total cost of ownership versus the cost of leasing, factoring in tax impacts, financing options, and strategic flexibility before making a decision. When evaluating the lease versus buy decision, it is crucial to consider the implications for cash flow, tax strategy, and the company's long-term objectives. For instance, leasing often involves a fixed payment structure, which can simplify cash flow management, especially for businesses seeking predictable, consistent expenses. However, this predictability comes at the cost of ownership, meaning the business doesn't build equity in the asset over time. By purchasing the asset, the company incurs higher upfront costs but retains control, which can be valuable if the asset will be used for an extended period. In some cases, buying is advantageous if the asset appreciates or retains significant residual value. Additionally, ownership allows businesses to fully leverage the asset without restrictions, such as limitations on usage or modification often imposed in lease agreements. From a tax perspective, leasing can offer immediate tax benefits through deductions on rental payments, while purchasing assets can provide depreciation advantages. The decision is also influenced by strategic factors, such as the business's need for flexibility, the risk of asset obsolescence, and the length of time the asset will be needed. A detailed cost-benefit analysis is essential to determine which option aligns best with the company's financial goals and operational needs. Replacement decisions. Replacement decisions are crucial for businesses looking to maintain operational efficiency while minimizing costs. When deciding whether to replace an asset, managers must consider the current asset's performance, its remaining useful life, and the potential costs and benefits of acquiring a new asset. A common approach to replacement decisions involves calculating the net present value, NPV, of continuing to use the old asset versus purchasing a new one. If the NPV of replacing the asset exceeds the NPV of retaining it, the replacement decision is typically considered justified. In addition to financial considerations, factors such as technological advancements, maintenance costs, and efficiency improvements from a new asset play a role in the decision. Older assets often have higher maintenance costs and reduced efficiency, which can negatively impact the business's overall performance. However, premature replacement of assets can be costly, especially if the old equipment still has a useful life. Companies need to carefully balance the costs of maintaining aging equipment with the benefits of new technology or improved efficiency. A systematic evaluation that includes financial metrics, strategic goals, and long-term impacts on the business will lead to a well-informed replacement decision. Beyond financial analysis, replacement decisions also involve considering the strategic goals of the business. For example, a company focusing on innovation or competitive advantage might prioritize upgrading to the latest technology, even if the old asset still performs adequately. This approach ensures the business remains competitive and can take advantage of improvements in efficiency, product quality, or service delivery. On the other hand, a business focused on cost containment may prefer to maximize the useful life of existing assets, opting for repairs and maintenance rather than replacements. When making replacement decisions, it is also essential to assess the potential impact on operations. Replacing equipment may cause short-term disruptions, such as training staff on new systems or temporarily reducing capacity during installation. These operational impacts should be carefully weighed against the long-term gains. Furthermore, businesses should consider the environmental impact of replacing assets, as sustainability and corporate social responsibility initiatives are increasingly important in today's business environment. Ultimately, replacement decisions are about striking a balance between managing costs, maintaining operational continuity, adopting new technologies, and ensuring that the business's long-term growth and strategic direction are supported. Capital rationing. Capital rationing occurs when a company faces constraints on the amount of capital it can raise or allocate to new investment opportunities. These limitations may be due to internal factors such as budgetary restrictions, or external factors such as market conditions or economic volatility. As a result, businesses must prioritize which projects to undertake based on their expected return and alignment with a company's strategic goals. In capital rationing, decision-making is often guided by techniques such as profitability index, PI, which measures the value generated per unit of investment, or net present value, NPV, which assesses the total value added by a project. Capital rationing requires companies to evaluate investment opportunities carefully, selecting those that provide the highest returns relative to the capital invested. In some cases, firms may be forced to reject positive NPV projects because of capital constraints. Additionally, capital rationing often leads to financial decision-making that emphasizes risk, as projects with higher returns may be riskier. To maximize shareholder wealth, it is crucial for companies to focus on projects that provide the best risk-adjusted returns, ensuring efficient use of available capital. In situations of capital rationing, companies may need to adopt creative strategies to allocate limited resources effectively. One common approach is soft capital rationing, where management self-imposes a limit on capital spending to maintain control over growth or avoid overexpansion. This type of rationing may be based on strategic priorities, such as focusing on core competencies or avoiding excessive debt. On the other hand, hard capital rationing refers to external limitations, such as restrictions on borrowing or a lack of available equity financing. Under these conditions, companies must optimize their capital budgeting process, often through rigorous selection criteria and prioritization. In addition to the profitability index, PI, and NPV, other techniques like equivalent annual cost, EAC, can help compare projects with differing lifespans and investment requirements, further aiding in efficient capital allocation. Capital rationing also involves managing the timing of investments, potentially deferring projects that can be initiated at a later date when capital availability improves. Companies may also consider raising additional capital or leveraging partnerships to overcome rationing constraints. Ultimately, effective capital rationing requires balancing long-term growth with short-term financial sustainability, ensuring that the best projects are pursued without overextending available resources.